Damn, that's a hell of an opening.
That's
I
quite
like it.
the intro, yeah.
I like it. Hey, why are you taking off your hat, buddy? What's going on
I'll
here?
keep it on. I'll keep it on if you want. Right, it goes this way.
Good to see you, Mark McArdle.
Good to see you, sir.
Thank you for being with us here on the 12th of May, 2025. You feel like the year's flying by or what?
This year has been crazy. It's like 3 years compressed into one.
I am really looking forward to this conversation. Of course, you were the Assistant Director of Mortgage Markets at the CFPB, the boogeyman, for 7.8 years. Prior to that, you worked at Treasury, and you got a long history in housing. So he goes all the way back. He told me not to talk about this, but, goes all the way back to your time, way, way back yonder. You've been in housing since 1996, Housing Policy Coordinator for the Chicago Lawyers Committee for Civil Rights Under Law. I guess you and this housing thing, you're inseparable.
Yeah, we're married, but I was only 12 years old when we got married in 1996, so that's why I look so youthful.
I'll tell you what, my face looks like a lobster. Have you noticed? I'm coming off a little bit of a cold. I've got the Kentucky Derby cold, which is standard. If I ever take,
not a bad look.
I love lobster. I don't know about you. Do you like lobster?
I love lobster.
So I'm in Northern Virginia, and you're. Would you call where you live outside the Beltway?
I am technically outside the Beltway, but it's very, very close.
Yeah. So you're in the Maryland area.
Mm-hmm.
It's really good to talk to you. So you left the CFPB in February. Did you leave on your own? Did you read the tea leaves?
Yeah. I mean, after the election, I started thinking about options, and I was surprised, like everybody, that the director was hanging on after the inauguration, and he did for like a week, 2 weeks, something like that. And I accelerated my search around when Rohit was fired, and then I had 3 directors in 1 week. I had Rohit first, then we had Scott Besson for like 6 days, and then I had Russell Vogt come in. And I think the writing was on the wall. Then mid-February, there was rumors of a massive layoff, and those rumors turned out to be true, though they were stopped by the courts. So right around then, I said, well, this might be a good time to leave. And I started looking very aggressively, and I luckily found a spot.
Yeah, you're at Newrez now. Got a great name in the industry: regulatory affairs, public policy, and stakeholder engagement. How'd you come up with that title? Did they give that to you?
I threw darts at very key words, and those are the ones that actually came out. So
yeah, well, we're going to talk about your new role, but we got to talk about your old role. At any point, did you feel like there was a sliver of hope that it would be left more intact than it was?
Nobody, I don't think, expected it to be as hardcore decimated as it was. Everybody knew that how politicized the Bureau was from the beginning. I don't know how many Supreme Court cases we've had, and even from the days of Cordray, rulemaking by enforcement, this has been a very controversial place. Under Kathy, it seemed like it was more normalized for a while there, but under the last director, Chopra, it seemed very, very politicized and very, very unstable. So I did not, while I expected them to greatly curtail the activities of the Bureau, nobody expected them to lay off or propose to lay off 1,500 out of 1,700 people or whatever they tried to do just the last few weeks.
Yes, there's really 2 windows, right? There's the window when Trump took over and Rohit hung on, and so that's the first. Obviously, the second window when they decided to try and lay off 1,500 people. Which is that still in the courts? That's still yet.
That's
to be
still in the courts.
Right?
4 days from now, they have another hearing, so we'll see what happens there. But I mean, I think most people think there'll be some degree of layoffs sooner or later. The question is, how many are the plans robust enough? I think the Bureau will be greatly smaller, in a year than it is today. That's, I think, true. But what they proposed was quite draconian, without a lot of us, trying to figure out who's good, who's not good, who do we need, There are lots of people at the Bureau who have been there for years. Some people who've been since HUD and were transferred over, know everything about RESPA. People who know our rules backwards and forwards. So like I said, you think you'd want to keep some of those people if you were going to change or keep everything, whatever you were planning on doing, you need some of those people around.
But in that window when Rohit was hanging on, What did you think was going on? Did you think, well, maybe this isn't going to be so bad after all, or you
No,
knew?
no, no. Yeah, I mean, there were a lot of theories about why Rohit was kept on as long as he did, and I think that I always suspected that they were waiting for Russell Vogt to get confirmed, because if you read Project 2025, Russell Vogt had a particular interest in the bureau. So if I was a betting person, I would have bet Russell Vogt would be our acting director. So that was my theory. Rohit, especially between election day and inauguration day, was amazingly aggressive. Like enforcement cases announced left and right. Amicus briefs.
I remember that there was a flurry. I feel like very little was done for 3.5 years, and then all of a sudden there was an absolute flurry
of activity, most of which now has been reversed. So it was all sort of performative, I think. But
what do you think that was
a crazy
about?
time period.
Was that just showmanship? Was he just peacocking?
A lot of it was. I mean, I'm of the school of thought that nothing lasts unless you try to build consensus, unless you try to go for the middle. And if you aim for the edges of the strike plate, which he always did, good chance you're going to get overturned. And a lot of the stuff he did, from enforcement cases to rules to advisory opinions to guidance, all of that have been withdrawn at this point. It's going to be hard. I'll be hard pressed to point to one thing he did that will remain intact. On the other hand, when you do go for the middle, like Kathy did with QM, that rule stayed. And there are other areas where I think there's a chance for consensus, like on the servicing rule, where if you go for the middle and, each side gives a little bit, you can get some lasting consensus. But that's not how we've been operating lately. Or not we, but how the Bureau was operating lately.
Yeah, it's hard not to say we.
Yeah, I've been there. I was there for a long time. So
for so long. So I'm curious, because you just mentioned that you are about consensus and having conversations. It doesn't seem like that was Rohit's style of leadership. It was more acting by enforcement. So what was it like working for someone philosophically that you weren't completely aligned with?
Usually not a problem. I mean, when you're career staff, I've been both political and career in my career. When you're career staff, you're used to disagreeing. Your job is to present what you know and to try your best to provide unbiased advice, or at least, all the options as you see them. And I'm routinely used to them going another way. That happens all the time. What was unusual about the last regime was career staff had very little chance to interact directly with the director. You normally, when you make a big decision on QM or something else, the director and all the people who were involved get together in a room and there's a meeting, and that never happened. Often they knew which way they were going, and staff were sort of told, go this way. You try to convey any concerns you had through your political advisor. That was the political that was assigned. But I had very little insight into the decision-making process, or, you just hear days later, the director decided that he's still going to do this or whatever. So I think for a lot of career staff, that was a frustrating process, because you sort of want to make your case in front of the decision maker. And that's something we're used to doing and have always been able to do for Kathy, for Mulvaney, for all our directors. Dave Weigio was an acting director, and Rich Cordray was my first. I only had him for a couple months, but all of them would interact more with staff than the last guy did.
Yeah. So I saw you speak on a panel about a month ago. Rich Sharga put on a great panel, invite only, in DC. I was privileged and honored to be in attendance, and the conversation came up about the CFPB, and you got emotional. You got really, really emotional. Why?
Well, I think all of us can agree that maybe the Bureau needed some degree of reform. You just don't like to see people treated poorly without regard to whether they were they were culpable in the decisions of the past. I mean, people should understand how the Bureau worked, which was there was one guy driving, and especially under the last 3 or 4 years, we didn't have a whole lot of say into which way the bus was going. Most of those people have a lot of expertise. They served under Republicans and Democrats. The vast majority of the Bureau that's there now also served under Kathy and did so successfully. And so to see this sort of process where when we had that meeting, literally everyone I know had already gotten a riff. People all across the agency, the good, the bad, the competent, the incompetent. Everybody got a riff, and without notice saying your job is gone. And that it's hard to see all your fellow coworkers go through that without a lot of transparency into what they were trying to do or faith that the process was sort of like strategic in any way. If you're going to shrink the bureau, but ask questions. Who are the good people? Who do we need? What do we want to accomplish, and what do we need to get there? This sort of idea of Silicon Valley, which I think they follow, is to fire everybody and then rehire what you need. That doesn't work in government, given the nature of government employees and how hard it is to hire. You're going to lose expertise. The Bureau's lost a lot of good people, David Blyken, Laura Johnson, people who have been there for a lot of years. And so it's hard to watch from the sidelines. And let's face it, I feel a little guilty having, managed to escape that. And then to see a lot of people you work with and who you respect go through that kind of experience. So yeah, I got emotional.
Yeah, well, I appreciate that, your candor. So states now appear to be stepping up their enforcement. Talk about that, please. Talk about what you know, because we hear, hey, a lot of people from CFPB came from states. They went to the CFPB. Now they're all going back, and watch out. What's your take? What are you seeing?
I think that's exactly right. There are people who are hired by Gabe O'Malley was enforcement, went over to the state of New York. There are others who went to other states. I think you see them gearing up. I mean, the thing everybody should realize is if you're going to reform the Bureau, you could go for it, reform it. But, the laws all are still on the books. Those laws don't go away. They're enforceable by states. They're enforceable by private actors. Most of them have what they call a private right of action, which means anybody can sue you. And then finally, the Bureau itself, if it changes direction in 4 years, has a look back period, and they can enforce these rules. So good companies should be focused on compliance still. But we already see activity in the states. I mean, I have a list of all these state actions. New Jersey has a modern redlining case going on. Massachusetts Attorney General is launching an investigation into junk fees. The state of Illinois is thinking about investing a community reinvestment act for non-banks. So we are going to see 50 flowers bloom in different state regulations. And part of my job at Newrez is to try to figure this out and get a handle on it. But it's going to be chaos. It's going to be a lot of different cats going in different directions. And, the Bureau used to play this leadership role with a lot of the states. We used to have monthly calls with the states to sort of talk about guidance questions and to make sure everyone was interpreting our rules the same way. That, I think, is going to not happen, especially if they fire 1,500 out of 1,700 people. I think there was going to be 10 regulatory attorneys left, right? So I don't know how much guidance you can do at that point or standardizing you can set.
Yeah, because the CFPB functioned as a sounding board between true and false. So states would call the CFPB and say, hey, looking at it this way, am I interpreting your rules properly? And your point that I'm picking up is that if those people aren't there anymore, people are just going to be left to their own device to come to their own conclusions. And so you're going to have to be running around in some instances proving things that you shouldn't even have to prove.
Right. And what if something changes? What if we go through a time period like 2022, again, when rates spiked up and there were questions about points and fees and the rate cap? There's going to be no centralized, or the Juneteenth holiday. You remember that? That was a holiday that was created out of thin air, and there were questions about does it count or doesn't it count for TRID? There's going to be nobody that can respond quickly to those questions or sort of stance, do I go to all 50 states and get their interpretation? That's going to be hard.
Yeah, for sure. Mark, biggest danger right now that you've not mentioned already for mortgage lenders that they should be looking out for? You talked about the look back period, so that's off the table. Like as you look at this moment in time, what are a couple of things that come to mind that you think that lenders should be extra cautious about?
Like I said, I think lenders got to keep their eye on the ball when it comes to compliance because of all these players. They have to pay more attention to states and make sure they do the ground game there. They should find partnerships with counselors and others on the ground, if you can get ahead of problems, that's the best case. So if there is a budding case in some state with private, litigants, you want to see if you can create channels where you can get on top of that. Paying attention to your own complaint line, I think, is a good way to go. I mean, what I worry about here is with a 50-state patchwork, there are going to be actors who are not local, perhaps not active nationally, who compete on certain states, which perhaps are less aggressive. And then you're going to have this problem with competitors who are relatively unconstrained, who are perhaps new to the scene. We'll see. And, companies like yours and mine are going to be around forever. So we have to play the long game. But I'm very curious to see what sort of actors arise if there is perceived to be in any way a vacuum of regulatory enforcement.
Got it. Dying to know how the CFPB arrived at who they decided to audit on the lending side.
Again?
I'm dying to know how the CFPB determined what lenders to look under the hood. Is it I'm guessing it's not just hey, your number's up. There was some kind of tells that said
no, we had a very robust process. I don't know if I doubt it is going on anymore, but it involved looking at complaints and normalizing complaints for the size of the institution, looking at the size of the institution and all these other sort of factors that would drive risk. So we create a risk list of actors on both the origination and the servicing side. I was only in mortgage, so that was what I focused on. And complaints were a big factor, as were sort of like, did we see a sudden spike or change in the profile of the lender? So you could look at year to year, quarter to quarter, because for the biggest guys, we had quarterly HMDA data too, and see if there was anything unusual in sort of the change in pattern. So there was a method to the madness. It wasn't just like, oh, who shall we visit today? And
what are some
the
of those
way it works, you have to
characteristics?
schedule so far in ahead. You have to plan 12 months in ahead almost to set schedule exams.
What were some of the characteristics of some of those factors, those change factors, when you talk about, lender moving in one direction or another? Is it volume going up and all of a sudden you're like, how did they get that? What are some of the characteristics that set off that alarm bell?
Yeah. So there's nothing that's like for sure a red fire trigger except complaints. I mean, obviously keep track of your complaints. If you have a disproportionate number of complaints, we're coming to visit you. Let's take that off the table. Other than that, there are a lot of other factors that could be involved. Like, did your share of applications suddenly increase or drop? Did your share of loans increase dramatically quarter to quarter? Did the interest rate, did you notice anything? Because there's a lot of data in HMDA that they report. We could actually see the credit profile of borrowers and sort of track that. And all of a sudden, someone relaxed their lending standards dramatically. That could be a red flag. Doesn't mean anything's going wrong. It just means, we should pay attention and make sure we understand what's going on there. And that's something I think lenders should do on their own. There's a lot of controversy about the Townstone case and whether that was overreach or not. But that sort of process of saying, where am I getting my applications? What do my applications look like? Am I doing everything I could to be making sure I penetrate all parts of my market? I don't think that should go away. That's sort of like a nonstop process to use HMDA data to compare yourself and benchmark yourself to your peers and get a sense of like, what are you doing that your peers are not doing?
We're about halfway through here. I have to ask you a question. Do you have birds in your house? I feel like I'm hearing birds.
I don't have birds in my house. I have birds outside my window.
I didn't know if you were like running a sanctuary now to offset your income loss.
Actually, I run a bird sanctuary. I had to get a job after the bureau, so that's why I have the hat.
I mean, you've got some. Listen, I will say this: you've got some very happy birds. You must feed them or something, or maybe they just are. Maybe they're happy you're not at the CFPB anymore. Maybe they were afraid they were going to get audited.
Yeah, well, there you go. I like
so when you talk about complaints, and that set off the alarm in some instances, how did the Bureau view consumer complaints versus employee complaints? So you've got the whistleblower line. Hey, these guys are paying this way and doing those kinds of things. Give us a window into that.
Yeah. So we obviously got a fair number of whistleblower complaints, and we always looked at them. But you do have skepticism, like, was the person fired? What is this? Is there any other data point that would support what they're saying or not? We would rarely just pursue a whistleblower complaint without any other evidence that would track that. For consumer complaints, we routinely did that. That was our biggest and most robust data set. We'd look both at the complaint and the company's response. And so you get a sense of whether these complaints had any basis in fact or not based on the robustness of the response. And, the whistleblower thing, I would say the most common thing I'd often hear is, I'm following the LO comp rules, but this person isn't, or whatever. You should look at this company who's not doing it. And we got a fair number of those. And those are harder to sort of follow up on because you don't necessarily see it in any data source. But That was a very common sort of whistleblower type
Well,
thing.
let's talk about that. Let's talk about LO Comp, because Dodd-Frank, had some very specific guidelines and rails put around that, and yet certain lenders pay, when they bring the rate down, which delivers a better result for the consumer. Some lenders would do that. Some lenders wouldn't. The lenders that wouldn't were really upset, obviously, and I know several that reached out to you guys and pushed really hard. Was that ever something, to your knowledge, that was close to really being looked at?
So under Kathy Kraninger, we were considering targeted changes, mostly just whether we carve out HFA loans, what they called state bond program loans from that. And we thought about, but weren't quite ready to, that was actually on the agenda. The regulatory agenda was the bond program part. And we thought about, and hadn't yet got to the point where we pulled the trigger on whether you can ding a LO for errors, ding their comp if they made an error. That one was easier to solve. The problem with the competition argument, which is the most common, probably the biggest impact, is, if you think about where the rule was designed, it was designed to sort of protect consumers from being incentivized into bad loans. And you're saying, well, we're only lowering our rate. But in a world where most consumers don't shop, that could net result in a higher rate for most folks. And you just lower it when you get someone who says, well, the person down the street is shopping. And then net, more people would end up paying more. And that's the argument that we had to look at and sort of evaluate. I think LO Comp and all parts of it are on the table. I know that there are people who strongly believe, Brian Levy and others, that the rule serves no purpose anymore. I would argue that if that's true, you make your case to the Bureau, and if there's anybody left, they can look at it and change it. But it is something that Congress told us to do. So, it was a response to a specific problem, which was, yield spread premiums and the like in the pre-2008 era.
Yeah. What is your opinion on LO Comp?
I could see arguments for both ways. Like, with other safeguards in place, do you still need this safeguard? I do sort of, the data I saw, the rough internal data from our Office of Research indicated that net, we would expect more lenders to actually end up raising, the baseline compensation and just lower it to competitive offers. And that would then mean that most consumers would be worse off if we allowed that sort of targeted competitive exception to the rule. I don't think you'd see a world where we get rid of the LO Comp rule altogether, but because of the statutory requirement, but we'll see.
RESPA reform. What are your thoughts?
I think RESPA reform is another area that's ripe. It's something I've had on my radar for a while. RESPA is a very old law. What is it, 73, 74? We're the only industry that's regulated this way. Dentists, others don't have these sort of requirements and restrictions. I think if you are getting a kickback to make a referral, that is clearly a relevant consumer protection. But the rule has to be updated at the very least to sort of reflect the sort of technological age we are. What is a referral? What isn't a referral? Is the consumer actually harmed? I would actually like to see a third test on the RESPA analysis, not just that you made a referral and that you got something of value, but that was the consumer actually harmed in any provable way by the transaction. I think that would be a very useful safeguard to keep RESPA in place. Like I said, when I hear the folks at the Bureau talk, including Mark Calabria and others, RESPA reform seems very far down the road. Like they're talking about the things they have to do and revise, like the 1033 rule and the 1071. He said they want to do the servicing rule, but not probably till next year. That would mean RESPA would be way at the end. And as you know, rulemakings take 18 months. Probably a rulemaking like RESPA would take longer, 2 years. And that means you're running out of time in this administration to do it.
Yeah, and then you got the midterms coming up here before we know it.
Yep.
So when I look back at your background, you were definitely someone that fought for civil rights. So when I look at the headline from a few days ago, Trump seeks to strip away legal tool key to civil rights enforcement, talking about disparate impact. Why don't you wax a little bit on that?
I mean, as I said, these laws are still on the books, whether this administration chooses to pursue disparate impact theories or not. I think it's a good common sense thing for lenders to take a look at their own lending patterns and make sure they're not missing opportunities. I mean, most lenders I know are not out to discriminate. They just sometimes fall into traditional patterns. Most of us want to expand our customer base any way we can. And if a consumer can make a payment, can make a mortgage payment, can sustain home ownership, and we're somehow not serving that piece of the community, I think that's we are losing out, and we would want to do that. So I think generally lenders want to do the right thing. I think this analysis is useful for lenders to do, just to be the most efficient and effective lender you can be. And back to the state point, this is not going away. States can pursue some of these laws. Private litigants can pursue fair lending laws. So I would think that you would still want to keep your eye on the ball if you were a lender.
So I've heard people on both sides of the question I'm going to ask you. Direct to consumer looks like it's going to be a thing now, like what Rocket's doing and what some other lenders are doing, to have a fully integrated process where there's title services, insurance, staging, electric, all these things wrapped up into one place. Good for the consumer or dangerous for the consumer?
That's one I don't know, man. I mean, I can totally see the danger of being caught in a captive network where you don't even see you're basically being shoved along. And that gives them tremendous competitive advantage too, to sort of, they don't have to do pricing, concessions or anything else if they have a captive consumer that they're shuffling around from one end to the other. I think the kind of RESPA issues we were just talking about are front and center for this sort of model. I mean, all of us, like Newrez, wants to find everywhere we can to reach consumers. Direct to consumers are biggest sector that's growing, but we don't have the full thing that Rocket's going to from soup to nuts. I think it's going to be one that we want to watch very closely.
What do you think about the direction the industry's heading in, what Rocket's trying to do? When you look from the outside, in all the years you've been in the business, they've got some really, really big aspirations, and so far they're doing okay. Now, obviously, the integration of the two entities they just sucked up are going to be, that's what we want to watch right now. But the industry is changing very fast, and of course there's AI too. I'd like you to touch on that.
Yeah. So one of the things that I'll start with the AI and then I'll work backwards. One of the things I always thought that we didn't do a very good job at the Bureau is sort of issuing the positive use case for AI, which I think there is a positive use case for AI. It allows us to sort of process data more quickly and in a way, to find opportunities for lending, to sort of find compliance problems more quickly, to help our customer agents deal with consumers in real time without making mistakes. I think there is a positive use case for AI, and I think it has tremendous ability to, down the road, to save us some money as lenders, per loan, to make sure that, fewer people can handle more loans, especially on the underwriting side. And then I got lost because we were going back. Oh,
I was just talking about the direction of the industry.
Right.
What do you think about it? Like, let's just stick with what Rocket's doing. When you see these things going down, what are your thoughts?
I absolutely agree with the near-term risk. I do remember distinctly having, started when I had started at Treasury during the great financial crisis. All these lenders had absorbed huge books. Wells bought Wachovia, Chase had bought WAMU, Bank of America, most famously, was forced to take Countrywide. Those were very, very painful and problematic transitions that I think took years to resolve, where their systems didn't fully integrate, where consumers did not get the best service. I'm hopeful that Rocket can, servicing's a lot better than it was. Technology has helped. I'm hopeful that they can avoid some of the worst pitfalls, but there's tremendous risk short-term for Rocket there. And also tremendous opportunities for other servicers to sort of who don't, I think there are going to be some investors who don't want to be part of that huge monolith servicing and may want more bespoke servicing. I think there'd be opportunities for servicers like Newrez and others to sort of to be helpful in that sphere. It can also be a very powerful company. There's no way to look at that and not be sort of impressed and say, like, this could be, they could get the leads, they could do the servicing. One of the things I like about Newrez is we keep our servicing. So, we originate and then we service, and you have that ongoing relationship with the customer. This takes it even further, from the realtor all the way through servicing.
Well, so, since you're talking about Newrez and you work there right now, I believe I've got a little background on Newrez off the top of my head. Acquired Caliber, right, years ago, and a ton of servicing, but then the retail has shrunk considerably since that time. So are you able to speak to if Newrez is going to try and grow in retail again, or would that be a question for somebody else?
That's probably a question for somebody else. I do know that one of the areas that we're most interested in is direct to consumer. Our biggest source of loans right now is correspondent. So I think we're the third or second biggest correspondent lender besides PennyMac. So correspondent's a big chunk. We have a robust and healthy broker market as well. And we're going to need alternatives to the big gorilla on that market. And direct consumer is the area I think we most want to grow, finding ways to reach the consumer. Rocket is by far, and UW is the biggest gorilla there. UWM is the biggest gorilla in the broker segment. So we have folks we're chasing. I think we have a clear strategy. I think we're showing progress, but it's clear who the leaders are here. And I think if we want to survive, we're going to have to find ways to reach the consumer and use all the channels. What I like about Newrez is we have all the channels: broker, direct, retail. Even we have all the products. We do FHA, VA, GSE, non-QM, and because we're part of Rhythm, we have a balance sheet. We can securitize our own loans. We have sort of a robust ecosystem that I think helps us, weather downturns and different directions in the market.
You worked at the Treasury for almost 8 years. You worked at the CFPB for almost 8 years. You'll probably be at Newrez because things happen in threes. So you'll probably be there for about 8 years as well. Let's be National Enquirer-esque for a moment. So you worked at the Treasury. When you see the president talk about the Treasury Secretary and you see that whole cat and mouse game, what do you think?
In what way?
Just you have an opinion when you hear the president call Powell Mr. Too Late. I'm sure you chortle a little bit, right?
Yeah. So like everybody, most rational people, I think we should leave the Federal Reserve alone, and that we want an independent Fed to sort of create a stable monetary policy in all different climates. I think there's very few sacred cows in America anymore, but let's leave the Fed alone. I'm hopeful. Secretary Bessent, you heard the news about China, that the tariffs are coming down. I mean, I was at a conference the other day. The word everybody talks about is uncertainty. This is crazy levels of uncertainty where tariffs are 140% one day and 30% the next, and they're on and they're off and this and that. I can't imagine being a small business or another trying to negotiate this in the supply chains and all this sort of like, what is this going to cost tomorrow thing? I think all of us are worried about the consumer and how they weather this and whether this affects the home buying market, and everything goes in different directions. Like today, the Treasury yield went up, right? Because they think that the chances of rate cuts are going down and they're more bullish, but that'll push up mortgage rates right at the most important time of the spring buying season. So, which has already been last week was good, but somewhat disappointing.
Yeah. What do you think of Bitcoin?
As a former government employee, I do not have Bitcoin. I have almost, I like.
Well, pretty soon it seems like we're moving in the direction where everybody in politics will have Bitcoin.
The ethics things are hard to believe. I worked in government for 15 years. I couldn't buy or hold almost any private stock. I could not hold Bitcoin. I could not accept a drink or any sort of gift above $10. And to sort of see like.
You're a rule follower, man.
I used to follow all the rules.
Since you were like a kid? Since you were a kid, were you like the rule follower?
Oh, when you're working for the taxpayer, you want to be extra honest and straightforward, but it does sometimes peeve you to see less adherence to the rules by others.
You're a tall guy. 6'4", 6'3"?
No, 6'1".
When you're as short as I am, when you're as short as I am, everybody looks like they're 6'5". Did you know that?
I don't want to be 6'5". I'd hit my head a lot.
Did you play sports?
I play sports a little bit now. I was a geek in high school, hence the hat.
Yeah.
So I did newspaper. I had very little athletic ability. I needed glasses and I didn't get prescribed them until much later. Now I'm pretty good at some sports, but not as good as my son, who's 17.
You read a lot of books?
Better at me than anything. What?
You read a lot of books? You look like a book reader to me.
I'm a big book. Yeah. Are you calling me a geek? You're right. I'm a book reader. I love books.
Not at all. Not at all.
My mother's a librarian and my sister's a librarian. So I come from a whole family of people who love books and love libraries. And So
I
books.
always had a problem being quiet, so me and libraries didn't get along very well.
I love libraries, and yes.
You love libraries.
Still, there
You
isn't a
love
library. If
libraries.
I walk by a library, I'm drawn just to walk into it.
What do you do when you're in there? Just look at every book?
Just look at the books, see if there's something I hadn't seen. There's always a section called Librarian Recommends. That's my favorite section because my mother and my sister were librarians, and I take a look through that and see if there's any books I hadn't read. And
Got to be quiet in libraries. You probably,
quiet.
I bet when you were in libraries and people were being loud because of the background of sister and mom, you probably got a little pissed off, didn't you?
My sister has that doll. It's a famous doll with a Seattle librarian who, if you push her on the back, she goes, shh.
Don't make me laugh. I'm getting over a cold. Let's go back to the CFPB, then we can end this. Scary monster, CFPB. I mean, do you realize how many years lenders spent in fear of the CFPB? How many times we've sat in conference rooms? Like aggregate as an industry, we have probably spent 1 million hours talking about, preparing. I want your opinion on the approach of the CFPB. Like if this thing ever gets rebuilt to any measure, 200 employees, 5, whatever it turns out to be, if the agency was more collaborative and we knew what was coming and how to participate in a partnership kind of way, what kind of difference do you think it would have made, and would it make?
I think it would have made all the difference in the past. I think there was a conscious decision when the Bureau first started, whether they were going to be more collaborative or they were going to try to make a splash, go as aggressive as they can. They're going to fight for the consumer. And that's all fine. But in the end, if you're going to be a long-term regulator, you have to balance interests and be that fair arbiter of everything. That doesn't mean you listen, you're captive by industry and what they say goes. That means you listen to all voices. You listen to consumer advocates, you listen to industry. And one of the things I proposed when I was leaving on my LinkedIn thing was maybe the Bureau needs like a board of directors, 6 industry, 6 consumer advocates, and they get to veto decisions. And that would sort of force a consensus-oriented mindset. But what you're talking about is even more important. Like, could the Bureau be more open and more aggressive with outreach, making sure that lenders and servicers and vendors had full access? I would argue there were times we did that better than others. There were times like, during the HMDA rollout where I think we were pretty good reaching vendors and others. Rich Cordray, even though he is famous for regulation by enforcement, always took a meeting with industry. So there is the elements needed, but they never sort of aggressively said, we're going to be a regulator for everybody. We're here to serve both the industry and the advocates and most of all the consumer. And the only way you do that is to make sure that you're talking to everybody, because like the old joke is that the safest loan is the loan you'd never make. You have to understand there's a business constraint here. And the more you push up the costs of making loans, that's going to hurt the consumer too. So you have to make sure that every action you do is equal and justified by the benefit, and that you sort of make sure you get the ratio right. I'm pretty sure we haven't gotten that ratio quite right yet. And if we worked closer with industry, I think we'd be more likely to get to that sweet spot. Not where, like I said, not that we're being captive to industry, but that you listen to industry, you balance all things. I used to say at Treasury, the ideal solutions were ones where everybody was a little bit unhappy. So if you guys are a little bit unhappy but not pissed, and advocates were a little bit unhappy, not pissed, we've hit the sweet spot.
Will you admit there was a little bit of bloat in the CFPB? I mean, 1,700 employees, really?
No, yeah, it could be smaller. We could rethink how we do things. I could absolutely try to think about different models. Do we need to have rulemaking teams as large as we did? Do we need to do exams the way we did? I mean, we used to do in-person exams with huge teams. When I worked at TARP, we did exams on lenders. We did mostly remote exams, and we only went in when we absolutely had to. And that was a very lean sort of model that was much more efficient. So there are definitely ways we could have. I don't know if the Bureau needs to be more than 1,000 people ever.
Would you go back? Would you go back? Would you go back?
I would go back for leadership that sort of was dedicated to this consensus central type opinion. I would because I do believe in the agency. I believe that it serves a purpose and it could be very effective if it sort of learned from the mistakes from the past, focused on sort of serving everybody. and sort of aim for that middle of the road. And I would go back for the right leadership in that. And sort of, I mean, this is a horrible time period for my coworkers, but if we can get beyond this period, there is a chance to build it back in a sustainable way better. But they have to start thinking about that. They have to start thinking about it now. Like, how can we put checks? I mean, I do agree the director has too much power. No one person should have that much power. That's why I was thinking about things like, maybe it's the commission, maybe it's a board of directors, but everybody needs a check. Everybody needs somebody who can say, I think this is a bad idea. And there's 7 of us here who agree, and you should maybe slow your roll.
I'll tell you what, Newrez is very lucky to have you. I'm sure they know that. This has been a real joy. I appreciate your time very much, your candor. I'm glad the birds are finally sleeping. You didn't curse. You didn't curse one time.
I know. It's
which
so
is
unusual.
Amazing because as we got ready for this, we all logged on at around 12:40 Eastern. I think you said 14 curse words. So pre-game, listen, pre-game 14, real game 0. And it's not really how you do it's not practice, man. It's the game. It's like how you play. Next Monday, Bill Lohman is going to join me. He's the vice chairman at APM, American Pacific Mortgage, one of the biggest lenders in the country. So that'll be next Monday at 1 p.m. Eastern. Also, a bunch of people heading to secondary New York. I'll be there for a day. Will you be there?
No, I'm actually going to be speaking about the States. The CSBS has a conference in DC that same time period. So I'll be here in DC going to that.
All right. Did I forget to ask you anything? If you were me, would you have asked you any other questions?
No, I think you asked all the right questions. And I'm actually hopeful for our industry and for the CFPB. So I'm a positive guy.
Likewise. I think we need some police around. I don't think you go from streets littered with police officers to none. That's not a good scenario for anyone. So hopefully we'll find a middle ground. Listen, I appreciate your service.
Thank you.
You served this country for over 15 years. And it's not lost on me. I'm sure it's not lost on the folks listening to this. So thank you so much for your service and for your willingness to talk about the ins and outs on the way out. So Mark, look forward to continuing this conversation soon. Look for the short guy. I'll look for the 6'5" guy with the sombrero. And we'll talk soon. My thanks to Dana Truchevsky for pushing all the right buttons backstage. Have a great week, everyone. See you next Monday. Bye-bye.
Thank you very much.